Welcome back to the Deep Dive, the show where we don't just read the headlines. We equip you with the strategic context you need to really understand the forces shaping the financial world.
That's right.
And today, we are conducting a truly comprehensive analysis of, well, one of the most powerful institutions on Wall Street.
We are. Our focus is a deep dive into the Morgan Stanley ticker MS fourth quarter 2025 earnings release. And we aren't just sifting through the noise here.
No.
We're using a pretty rigorous 5-part analytical framework that was provided in our source material. This structured approach, it sort of forces us to look past the surface level numbers, the revenue and profit figures, and really zero in on the underlying strategic and operational drivers of this bank's performance. This gives you, the listener, a shortcut to understanding why the numbers move the way they did.
And the high-level story here, it's a massive vindication for them. Morgan Stanley concluded its fiscal year 2025 with performance metrics that, frankly, just significantly outpaced what Wall Street was expecting.
It really did.
The core narrative is the ultimate validation of their multi-year strategic pivot toward what they famously call the integrated firm model. It's a story of a firm that's really designed to capture that high-growth upside when markets are strong, like they were in Q4,
Right.
while also maintaining this structural stability for when volatility inevitably comes back. It's resilience meeting opportunistic growth, perfectly captured in one quarter.
Precisely. And for anyone studying financial institutions, these Q4 results they're a textbook example of how a diversified, complex firm executes its strategy, just flawlessly, and at a crucial economic inflection point, no less.
Right.
We are seeing the cyclical businesses, I'm talking specifically about investment banking, roaring back to life after a pretty long period of dormancy. And at the same time, the stable, fee-based businesses like wealth management are just continuing their quiet, relentless compounding.
Okay, let's unpack this with our first analytical lens. Now for slide 1, the at-a-glance scorecard. We begin with what the market saw immediately. Headline numbers and, how decisively they stacked up against what everyone was expecting.
And the primary message from this first scorecard is what analysts call the double beat. It's a great term.
The double beat.
Morgan Stanley didn't just meet expectations. They decisively outperformed Wall Street forecasts on both the top line, which is your revenue, and the bottom line, which is earnings per share or EPS.
And a beat like that on both is the clearest signal you can get of broad, successful execution across the entire organization.
It really is.
So let's get into the scale of this operation. For the top line, Morgan Stanley reported net revenues of $17.9 billion for the quarter.
$17.9 billion. And critically, that's a robust 10.3% year-over-year increase compared to the $16.2 billion they reported back in Q4 2024.
And for a bank of this size, double-digit revenue growth is a really powerful indicator that the capital markets, M&A activity, IPOs, they're truly blossoming again.
Yeah. Absolutely. And crucially, that growth wasn't just bought at the expense of profitability. When we look at the bottom line, net income applicable to common shareholders surged to $4.25 billion.
Wow.
That reflects an even more impressive 19.2% increase year over year, up from about $3.6 billion a year prior. And that tells you the growth is highly profitable. It's not just being swallowed up by rising costs.
And that $4.25 billion figure,
Okay.
that's the number they use to calculate the big one, earnings per share.
That's the one. That is the exact pool of profit used to calculate that metric that every shareholder watches.
Which brings us to the ultimate metric of managerial effectiveness. Diluted EPS, this figure climbed to $2.68. That is a staggering 20.7% year-over-year increase compared to the $2.22 they did in Q4 2024.
And a brief but I think vital distinction needs to be made here. You'll see Morgan Stanley also reported a basic EPS of $2.72.
Right, a little higher.
A little higher. But the market, the analysts, the consensus estimates, they always focus on the diluted number, the 268. And the difference is critical for understanding shareholder value.
So break that down for us. Why the focus on diluted?
Well, basic EPS just assumes only the existing common shares are out there. Diluted EPS, though, is the more conservative, more realistic measure. It assumes that all potentially convertible securities, things like employee stock options or convertible bonds that could become common shares, do become common shares.
So it spreads the profit over a bigger potential base of shares.
Exactly. It slightly dilutes the total profit. Wall Street demands the diluted figure because it represents the most conservative, sort of worst-case scenario for the earnings attributable to each share you hold. The focus on 268 confirms they cleared that higher hurdle.
Okay, makes sense. So we know the raw numbers were good, but in the world of finance, it's really the element of surprise that moves the stock. How significant was this double beat when you measure it against what the analysts were actually forecasting?
Oh, it was significant and decisive on both fronts. On the top line, the $17.9 billion they reported comfortably exceeded the analyst consensus estimate of $17.72 billion.
So a beat of about $180 million on revenue?
Correct. And beating the revenue number by that much signaled immediately that analysts had, well, they'd severely underestimated the velocity of the recovery in their core businesses, especially investment banking.
But the EPS surprise was the real headline grabber.
It was. It was truly massive. They reported 268, which absolutely smashed the consensus estimate of $2.41.
Yeah.
That difference, 27 cents per share, translates into an 11.2% earnings surprise. For a firm the size of Morgan Stanley, that margin of victory is just enormous. It really suggests structural improvements were at play, not just, some cyclical luck.
And the market saw it that way, too.
Oh, exactly. Investors immediately rewarded the results, pushing the stock up sharply. It surged 5.2% in the trading session right after the release, closing at $190.16.
And that kind of immediate, strong price movement tells you the market views these as high-quality earnings.
That's right. They're seen as being driven by sustainable, core business fundamentals and good management execution, not just some temporary boost.
Now, here's the core analytic question that comes out of this slide, and it's a fascinating one. Why did EPS grow so much faster than revenue? We saw a 10.3% revenue jump, but a 20.7% EPS jump. When profit accelerates at double the rate of sales, the company has to be pulling some serious financial levers.
Absolutely. The disparity points to two primary drivers, or levers, that management skillfully employed during Q4. The first is operating leverage, and the second is share repurchases.
Okay, so let's take those one at a time. Let's start with operating leverage. For our listeners, this is that classic concept of growing your revenue faster than the costs it takes to produce that revenue.
It is the ultimate goal for any large-scale, high-fixed-cost business, and especially a global bank. And Morgan Stanley just achieved this beautifully. We know net revenues grew by 10.3%.
Right.
Critically, their total non-interest expenses increased by a much lower 8.1%. That 2.2% differential, that's it. That's the operating leverage in action. Analysts often call this the Jaws effect.
The Jaws effect. I love that visual. The mouth of profitability just opening wider.
That's the one.
And when we look closer at their cost discipline, the data is really specific.
Yeah.
Our sources highlight that non-compensation expenses, so all the costs outside of salaries and bonuses like rent, tech, market data fees, they grew by just 3%.
Which shows incredibly tight control over their fixed costs, precisely while their deal-making fees and asset management revenues were soaring. It's beautiful execution.
And this discipline, it gets distilled down into one key metric, right? The efficiency ratio.
It does. The efficiency ratio is just the percentage of your revenue that's eaten up by expenses. And it improved, which means it decreased from 69% to a highly competitive 68%.
So a full 100 basis points of improvement.
Exactly. That drop signifies that it costs this firm less to generate each dollar of revenue. If you're generating 10% more in sales but only increasing your costs by 8%, more of that revenue just cascades directly to the bottom line. This kind of efficiency is what separates the elite firms from everyone else.
Okay, so lever one is management executing superior operational efficiency. Now for lever two, which you call the turbocharger for EPS growth, share repurchases.
This is pure financial engineering, and it provides a permanent structural benefit to all the remaining shareholders. During Q4, Morgan Stanley executed $1.5 billion worth of common stock repurchases.
And when a company buys back its own stock and retires it, the total number of shares out there shrinks.
That's it.
And the beauty of the math is that it's just universally positive for EPS. You take the same amount of net income, but you divide it by a smaller number of shares, which automatically boosts the resulting EPS figure.
Exactly. The buyback resulted in the weighted average common shares outstanding dropping from about 1,583 million to 1,564 million. That's roughly a 1.2% reduction in the denominator.
So that reduction, completely independent of any deals they closed or assets they managed, it just gave a deliberate, non-trivial boost to that 268 EPS figure.
It did. So that 20.7% EPS growth is truly a powerful cocktail. You've got 10.3% revenue growth, plus enhanced operating efficiency, plus a shrinking share count. That is the full story of superior execution you find in just this one at-a-glance scorecard.
Moving to slide 2, the engine of profitability. So we've established that Morgan Stanley successfully grew revenue by 10% and profit by 20%, thanks to those twin financial levers. But the next strategic question is so crucial for any long-term holder. Was that growth, quality growth?
Yes.
That shifts our focus entirely from the quantity of growth to the quality of how they use their capital, which is the entire story of this second analytical lens, the engine of profitability.
And for a global financial firm, the focus immediately shifts to the returns they generate on the capital they hold. And the single most important figure here is the return on tangible common equity, or ROTCE.
So why is ROTCE considered the gold standard? We also see a regular return on equity, or ROE figure. Why the focus here?
Because ROTCE is the purest, most demanding measure of capital efficiency. It strips out intangible assets, mainly goodwill, from the equity calculation.
Right.
And since Morgan Stanley has made some major strategic acquisitions over the years, E-Trade, Eaton Vance, they carry a significant amount of goodwill on their books. ROTCE measures how effectively they generate profit using only the tangible capital they hold, the real, verifiable assets. It's the ultimate test of economic reality.
And the result here is, well, nothing short of stellar. Morgan Stanley delivered an ROTCE of 21.8% for the quarter, and that's up significantly from 20.2% a year ago.
That number needs some serious context for you, the learner. For global systemically important banks, or GSIBs, the biggest of the big in ROTCE, consistently above 20%, is absolutely considered best in class. It's elite territory.
So why is that so critical?
Because their estimated cost of capital, what it costs them to fund the business, is generally in the range of, say, 10 to 12%. When a firm is consistently generating returns that are nearly double its cost of capital,
It justifies a much higher valuation.
it validates a massive premium valuation in the market. This 21.8% isn't just a high number, it's a strategic defense. It fundamentally justifies why Morgan Stanley has historically traded at a higher price-to-book multiple than nearly all its big rivals. It signals superior, sustained capital management.
That distinction, the link between superior ROTCE and premium valuation, that's the real nugget of insight here. And what's fascinating is that the operational improvement we talked about in slide 1, it shows up clearly in their pre-tax margin.
It's the direct connection. The pre-tax margin tells you what percentage of revenue is left after covering all your operating expenses before you pay taxes. MS Plurn reported pre-tax income of $5.76 billion on that $17.89 billion in revenue, which gives you a very healthy pre-tax margin of 32.2%.
And that's a sharp expansion. 200 basis points, or 2% from 30.2% a year ago. This margin expansion is the mathematical proof that their cost controls and their pricing power worked exactly as designed.
Indeed. It demonstrates that the revenue growth came with a minimal proportional increase in overhead. You had stronger pricing power in that booming investment banking division, combined with the exceptional cost discipline we saw, that directly drove that margin expansion. It creates a virtuous cycle where high revenue growth actually accelerates margin improvement.
And you mentioned the distinction between ROE and ROTCE earlier. The standard return on equity was reported at 16.9%, up from 15.2%. So that gap between the 16.9 ROE and the 21.8 ROTCE, it really visually captures that tangible capital story.
Precisely. The sizable gap is a visual marker of the intangible assets, the goodwill, from those big acquisitions like E-Trade. But the market recognizes that the firm is generating these incredible returns on the physical capital it employs, which is why that 21.8% ROTCE figure commands so much respect.
Let's shift to tangible book value per share, or PBVPS. This is a non-GAAP metric, but value investors track it religiously. MS reported $50 even, a substantial increase from $44.57 a year ago.
And TBVPS growth is crucial because it represents the rising theoretical hard asset value backing each share of stock. You can think of it as the continually rising floor for the stock price.
Right, so it gives a long-term investor comfort that the intrinsic value is growing, regardless of what the market does day to day.
Exactly. Hitting $50 and growing it by over 12% year over year is a massive source of comfort for value-oriented shareholders. It confirms that capital generation is accelerating.
So to sum up this second lens, we have to look back at that operating leverage data point one more time, because it really is the fundamental economic engine here.
We just can't overstate the power of that Jaws effect. The core of Slide two's success, the improved 68% efficiency ratio, the 32% pre-tax margin, the 22% ROTCE, it all traces its origin back to that 2.2% differential we identified earlier.
The 10.3% revenue growth minus the 8.1% expense growth.
That's the one. That is the strategic mechanism management is using to convert general market opportunity into amplified, compounding shareholder returns.
Moving on to Slide 3, the engine room business segment performance.
Okay.
Excellent. So having established the quality and efficiency of the overall performance, we now turn to our third lens, the engine room. This is where we see that integrated firm strategy really come to life, separating the high-octane cyclical drivers from the stable, protective anchors.
Morgan Stanley's structure is fundamentally designed to manage economic cycles. They use the volatility and upside of the Institutional Securities Group, or ISG, to turbocharge growth when markets are hot. And they rely on the predictable fee-based income from wealth management, WM, to provide a stable foundation when markets inevitably cool off. And Q4 2025 just shows this design running at peak efficiency.
The firm is beautifully balanced. Wealth management was 47% of revenue, institutional securities was 44%, and investment management was 9%. That balance is the primary reason the market gives MS that low-risk premium valuation. It is. So let's start with segment 1, Institutional Securities Group, ISG. This is the cyclical growth driver, representing 44% of revenue, and this quarter, it just roared.
ISG revenues hit $7.9 billion, a 9% increase year over year. But the core story within this segment is entirely dominated by the spectacular revival of investment banking.
The renaissance moment we've been waiting for. Investment banking, or iBuy, revenues skyrocketed 47% to $2.4 billion. When you see a jump like that, it's not just slow growth, it's a snapback moment.
It is the return of genuine animal spirits, as Keynes used to call it. And we can see exactly where that growth came from. Advisory revenues, which come from large strategic M&A deals, jumped significantly to $1.13 billion.
Which tells you that CEOs are finally confident enough about the economy and interest rates to pull the trigger on those huge mergers that had been sitting on the shelf.
That's exactly it. And the underwriting side was incredibly active, too. While equity underwriting got a boost from the reopening IPO window, the fixed income underwriting business nearly doubled, hitting $785 million.
Nearly doubled. That's evidence of corporations rushing to issue debt, right? Locking in rates.
Yes. Companies were taking advantage of what they saw as favorable market conditions. It shows strong balance sheet optimization happening in the corporate world, and it was a massive tailwind for MS in Q4.
Now, within ISG, sales and trading was a more mixed picture.
That's right. The trading desks were not uniform. Equity sales and trading posted a very healthy 10% increase to $3.7 billion. And this success was fueled by strong client activity, but more specifically, by higher financing revenues in their prime brokerage division.
And let's pause there, because prime brokerage is such a crucial business for them. Higher financing revenue there means what exactly?
Prime brokerage is their high-margin lending and servicing business for hedge funds. So when MS reports higher revenues here, it means the sophisticated, smart money investors are increasing their borrowing, using more leverage to place bigger bets in the market.
So it's a deeply bullish signal, both for Morgan Stanley's business and for overall market sentiment.
It is. Conversely, the fixed income sales and trading segment, which handles things like foreign exchange and commodities, experienced a decline.
Okay.
It fell 9% to $1.8 billion. Management said this was directly due to lower volatility in FX and commodity markets. When those markets are calm, trading volumes just go down. But
this dip is the perfect illustration of the integrated firm model. That 9% volatility hit was just easily absorbed and offset by the massive 47% surge in investment banking.
And the anchor provided by wealth management.
Which brings us seamlessly to segment 2, wealth management, or WM, the stability anchor. And at 47% of total revenue, it is now Morgan Stanley's single largest contributor.
This is the foundation that justifies their premium valuation. The goal here is relentless compounding. Net revenues hit $8.4 billion, up a strong 13% year over year. And that revenue growth, coupled with a robust pre-tax margin of 31.4%, it just underscores the incredible quality of this business.
A pre-tax margin over 31% in wealth management, that implies some serious economies of scale.
They have them. The key drivers are multifaceted. First, asset management revenues rose to $5 billion. This is highly correlated with the S&P 500. As the market goes up, client assets grow and their fees automatically increase.
Second, and maybe the most important measure of future health, net new assets, NNA. They attracted a colossal $56.5 billion in NNA just in Q4.
And NNA is the true test of market share capture. This is fresh money walking through the door. This influx of assets guarantees higher, predictable recurring revenues for years to come. It's a powerful compounding effect.
And third, there's the net interest income, or NII, story. It grew to $2.1 billion. And this was noteworthy because analysts had feared something called cash sorting.
That's right. Cash sorting is when clients move their cash out of lower-yielding bank accounts and into higher-yielding money market funds. The growth in MS's NII suggests they successfully managed to retain significant client cash balances, which is a major win in a high-rate environment.
And finally, we should briefly acknowledge segment 3. Investment management, the asset gatherer, providing the last 9% of revenue.
Right, this segment adds scale. Net revenues were up 5% to $1.7 billion. The core stability is shown by the asset management fees increasing to $1.65 billion. And their total assets under management, or AUM, reached a gigantic $1.67 trillion. This just supports their long-term goal of becoming an asset-gathering behemoth.
Now for slide 4, financial strength and shareholder rewards. We've established the profitability and the operational excellence. Now we transition to our fourth analytical lens. This is where we examine the fortress balance sheet that underpins the whole operation and the firm's commitment to capital return.
The central question here for investors is really twofold. Is the bank safe enough to withstand a severe shock? And do they have enough excess capital to aggressively reward their shareholders?
And the ultimate measure of safety is that Common Equity Tier 1 ratio, the CET1 ratio. It's the critical cushion against unexpected losses.
And Morgan Stanley reported a standardized CET1 ratio of 15.0%. Now, you need to benchmark that number. For the largest global banks, the regulatory minimums are usually in the 10 to 11% range.
So operating at 15% means they're holding a significant buffer of capital, about 4 to 5 percentage points above what's required.
It makes them exceptionally safe and stable.
But I have to ask the critical question here. If that much capital, that 4 to 5% excess buffer, is just sitting there, isn't that a massive opportunity cost? I mean, are they truly being good stewards of capital if they're not deploying it? Or are they just hoarding cash for a rainy day? Or maybe a giant transformative acquisition?
That is the perennial debate in banking, and it's a vital strategic tension. The counter-argument is that maintaining a 15% CET1 ratio is itself a strategic advantage. First, it offers maximum insulation against any future regulatory hikes.
Okay.
Second, and more importantly, it makes them exceptionally agile. They are somehow achieving extreme safety and that elite near 22% ROTCE. This combination means they can generate high returns even with a highly conservative capital posture while keeping the war chest ready to potentially acquire a large competitor.
So it's an optionality premium built right into the balance sheet.
That's a great way to put it.
And for long-term value investors, we have to reiterate the tangible book value story again. That 12% increase year over year, reaching $50, provides a continually rising margin of safety.
It acts as a financial anchor. The underlying capital cushion is growing faster than their assets, guaranteeing that the intrinsic value of the business provides robust support for the stock price.
And because they're generating so much excess capital, they can be highly aggressive in their capital return strategy, which is the second half of this slide. Let's talk about the buybacks.
They repurchased $1.5 billion of common stock in Q4 alone. For the full year 2025, that was a massive $4.6 billion. This is management's ultimate vote of confidence. Buybacks permanently reduce the share count, ensuring every dollar of future earnings is divided among fewer owners.
And the dividend story remains consistent and reliable. They declared a quarterly dividend of $1 per share.
At the current stock price, around 190, that translates to an annual dividend yield of about 2.1%. Now, while that yield might not top the charts, it is safe, it's growing, and it's backed by exceptionally strong earnings coverage.
So the total return profile, the 2.1% dividend plus the aggressive buybacks plus the 12% growth in TBV is incredibly compelling.
It is for both income and growth investors.
And one final quick note on tax efficiency. Their effective tax rate was a normalized 23.2%. No surprises.
Very stable. Makes future earnings modeling much more reliable.
And finally, slide 5. The road ahead management's outlook and key takeaways.
The home stretch.
This is where we distill the future narrative, the strategic focus, and the overall summary of a quarter's success right from management's own commentary.
And CEO Ted Pick's commentary was, as you'd expect, very confident. He positioned the quarter as a capstone on their multi-year strategic transformation. He said, and I'm quoting here, "Morgan Stanley delivered outstanding performance in 2025. Our performance reflects multi-year investments which have contributed to growth and momentum across the integrated firm."
So he's framing it not as just one good quarter, but as the validation of a decade-long strategic effort to de-risk and diversify the bank.
Precisely. And he crucially confirmed the positive macro environment they capitalized on, explicitly stating investment banking activity accelerated and global markets remain strong.
That's the CEO confirming that the long-awaited cyclical recovery has actually arrived, and it's sustainable.
Yes. And looking ahead, the strategic focus remains laser sharp. Asset gathering. Pick highlighted that their total client assets grew to $9.3 trillion. They are now within striking distance of their highly ambitious public target of reaching $10 trillion in client assets.
10 trillion. And the evidence is in the numbers. They gathered over $350 billion in net new assets for the full year.
It just demonstrates that their recruiting efforts, their tech investments, that E-Trade integration, it's all successfully winning market share.
So having processed this mountain of data through our 5 analytical lenses, if you had to boil this all down, what are the what's here? What are the key takeaways for the retail investor?
I think we can synthesize 4 primary actionable insights. First,
Takeaway 1.
the integrated firm model works perfectly. This is the core story. The stable revenues from wealth management are successfully offsetting the volatility in capital markets. A 9% dip in fixed income trading still resulted in 10% overall revenue growth. That proves the model.
And that reduced volatility warrants the premium valuation.
It does. Takeaway 2. Investment banking is unequivocally back, and MS is leading the resurgence. That 47% surge in IB revenue is the single most powerful bullish signal in the whole report. It suggests a high degree of corporate confidence and a busy pipeline for future deals.
Takeaway 3.
Elite profitability and efficiency. This firm has become a high-margin, cash-generating machine. The 68% efficiency ratio proves tight cost control, and the near 22% ROTCE validates their superior use of shareholder capital. They convert opportunities into disproportionate profit.
And the last one? Takeaway 4.
Aggressive, structural shareholder friendliness. The total return profile is just extremely attractive. It's a compelling combo of a safe, growing 2.1% dividend yield, massive share buybacks, and that 12% growth in tangible book value, which continually raises the floor of intrinsic value.
The final narrative, then, is that Morgan Stanley has successfully executed its transformation. They've gone from a high-volatility, trading-centric shop into a diversified, high-return financial compounder. And this quarter confirms they navigated the crucial economic pivot point of 2025, setting a very high bar for the years ahead.
Well said.
That brings us to our final provocative thought for you to consider, something for you to mull on as you process the strategic implications of this massive quarter.
We spent some time discussing Morgan Stanley's fortress balance sheet and that impressive 15% CET1 ratio, a substantial buffer above regulatory minimums. And while this high safety level is reassuring, it also necessitates a critical strategic choice for management. What is the most likely long-term use for this vast multi-billion-dollar capital cushion? Does maintaining this ratio signal that management is preparing to execute a massive strategic, maybe even transformative acquisition in the wealth or asset management space, a move that would fundamentally alter their scale? Or does it simply guarantee years of accelerated market-supportive share buybacks? That strategic decision deployment versus distribution is the central capital management dilemma that will define Morgan Stanley's growth trajectory over the next 5 years.
That is a phenomenal question to leave hanging in the air. We covered a huge amount of ground today, moving from the double beat and operating leverage all the way through to the strategic implications of that huge capital cushion.
We did.
Remember, this is not financial advice. Please do your own research and due diligence before making any investment decisions. This report was generated by an artificial intelligence model, integrating data directly from Morgan Stanley's official earnings press release with publicly available market data.
As always, thank you for diving deep with us.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.